Geoff Dennis, who's joining us on the phone line. Geoff, we're all trying to, collect our wits and understand what's really happened overnight on Wall Street. What are you making of the sell-off? And, when we first started to see this earlier in the week, yes, we attributed it to the coronavirus scare, but now it seems to only be worsening.
Yes, and I think it is fundamentally based on the coronavirus scare, without any question, and the danger for this for the world economy. I think there are some other factors perhaps playing a role. The concern that Bernie Sanders may be the Democratic nominee for the president, for example. I think that's a minor factor here, but it obviously is the coronavirus. And the point I've made to people, and I think it's the most important point here, is that this is hitting at a time when the global economy is already quite weak, in fact, very weak. You have a number of countries that are either in recession or very close to recession in the developed world: Japan, Germany, Italy, of course, where the virus victims, the virus cases are high. The UK, post-Brexit, Korea, Brazil, Mexico, South Africa, a lot of weak economies. And so I think what's happening here is the markets are behaving as if the virus and its effect, which are going to be dramatic on the activity levels in the short term and on corporate earnings, could be enough to tip the global economy into recession. Which is very different from SARS in 2003 and H1N1 in 2009, which occurred as the global economy was coming out of recession and equity markets were coming out of a bear market. So the timing of this is very unhelpful, and I think this is what's exacerbating the scale of this big downturn in the U.S. and other markets.
Geoff, the way markets are reacting, it is reminiscent of what happened in 2008 or 2013 or perhaps even after 9/11. Now, world's not going to end. The way financial markets are selling off, at least it appears by looking at the screen that someone is in a mood to really, sell and get out. The pain is not that high, but the market reaction, you think, is amplified.
Well, I think part of the problem here is that we just had gone up so far. And you mentioned this in the intro. We just gone up so far. Not so much, to be fair, in emerging markets, but certainly in the U.S. market. Valuations have got very stretched. Melt up was the phrase towards the end of last year, the beginning of this year. And this has been a dramatic turn because of that. It's worth pointing out that the close today, the S&P is only back to where it was in October. And so I think we have to put, the sell-off we've seen here in the context of that. Now, there's no earthly reason why this should be anything like 2008, because you don't have this dramatic collapse of the financial system, which you had then. It's probably not as major a geopolitical event as 9/11 was, but until we get a sense of how broad and wide this virus is going to be, I think the markets will be under pressure. I think all you need to do is to just look at what's going to happen to the activity data. The investment banks are all coming out with numbers, 2-3% for Chinese GDP growth in the first quarter. The corporate earnings warnings: Microsoft, Apple, United Airlines, MasterCard are coming through thick and fast. There's going to be a lot more of those. As everybody knows on the program, activity levels have basically stopped in certain sectors, such as tourism, such as cruise ships, airlines, etc., with respect to China. And I think the impact is going to be very significant. This hits against the background of very overextended markets. So I don't believe this is a buying opportunity yet. I just think it's far too early.
Thanks very much for joining in and giving us that perspective.